On today's World Insight, China's top policymakers gear up for the 15th five-year plan, which charts the nation's course from next year, 2026 to 2030. Amid global uncertainties over U.S. tariffs and other trade barriers, what's the big picture for the Chinese economy? International investor Jim Rogers weighs in along with the panel.
Hello and welcome to World Insight with me, Tian Wei. This October, China will study the proposals for formulating its 15th five-year plan for national economic and social development from 2026. It comes amid crippling trade and increasing market volatility and a resilient Chinese economy with about 5.3% year-on-year GDP increase in the first half of 2025 and an estimated 30% contribution to global expansion. During the 14th five-year plan, from 2021 to 2025, China has made significant progress in consumption, foreign trade, and investment cooperation. And the actual use of foreign direct investment has reached more than $700 billion US. In the next 5 years, China will strengthen international cooperation, increase trade resilience, and build an international trade pattern of openness and collaboration. So what is ahead and how attractive is China still going to be in terms of international investment from all over the world? Let's ask the people in the know. Joining us now in Singapore, Jim Rogers, chairman at the Rogers Holding. Good to see you, Jim, again. Over the weekend, I understand you have been making it public that you are holding on to the stocks of China. Tell us why. Why is China such an important place for international investment, including for you?
China is going to be the next great country in the world. You know, China was great 3 or 4 times in history. It's going to happen again. China is the only country in history that's been on top 3 or 4 times. Rome was great once. Egypt was great once. Britain was great once. China was great 3 or 4 times, and it's happening again.
Now people are looking at the tariff war the U.S. has against the rest of the world, especially with the latest rounds of announcing the tariffs to most of its trading partners once and again. So what do you think this round would mean? We see the stock market didn't do very well last weekend. We also see the job numbers.
Tariffs have never been good, maybe for a few days, maybe for a few weeks, but tariffs have never been good for anybody for any long period. So I am not optimistic. I have sold everything in the United States, all of my shares, because I'm worried about what's going to happen. The United States stock market has been going up since 2009. That's the longest in American history. And now tariffs will just make it worse.
Now, as we know, when the tariff negotiations are going on, if they can still go on, there are issues that is going on in the rest of the world. There's likely to be this seismic change of global trade system as a result of the U.S. back and forth. So do you see that have much impact on investors' choices?
Conway, let me say to you that when the next time we have a problem in the world economy, it's going to be very, very, very bad. We haven't had a problem for many years, and now, because of many problems in the U.S., including taxes, including high prices, when we have a problem again, it's going to be a very serious problem. Will China continue to open up and continue to trade with the rest of the world? That's the most important thing. If that's going to change, that will be a problem for China and a problem for the world.
In the upcoming 15th five-year plan, it seems that discussions about China's economic policy, trading policy will continue. What do you think, as an international investor, season one, should be included in those discussions?
As far as I'm concerned, the only thing that should be discussed is how do we open up more and more? How do we trade more with the rest of the world? How do we get the rest of the world to trade more with us? China will be the most important economy in the world, and Beijing should do everything they can to encourage that and to help it along.
In the next 5 years, Jim, as you know, we are going to see quite some interesting development for the relationship between China and the United States, for example. We are also likely to see what is going to be the impact of some of the latest phenomena, such as the U.S. debt, U.S. dollar, as well as the international trade realities evolving. How do you see these different factors going to contribute to investors' final decision as to where to put their money and where to put their actions, not just words?
Conway, the United States is the largest debtor nation in the history of the world. 100 years ago, Britain was the #1 economy in the world, but 50 years later, they were bankrupt, and nobody wanted to put money in Britain. That is going to happen to the United States. We have gigantic debts, and the debts are getting worse every day. I don't like this. I'm an American. I don't like it. But I have to face reality. I have children. They have to face reality. And the reality is the U.S. is a gigantic debtor, and it's getting worse every day. You should be worried. If you're not worried, I am worried. I am worried about what's going to happen in the U.S. in the next 2 or 3 years. I said 2 or 3 years. I didn't say 2 or 3 decades. It's going to happen sooner rather than later.
Well, all of the money, quote unquote, earned from the new tariffs are going to help with that situation at all? Or is going to be just a drop of water in the big ocean?
Many people want to invest in the U.S., want to trade with the U.S., and want to visit the U.S. The U.S. is still a very important economy. That will continue. But, Conway, we all need to understand that that will change, just as Britain changed. The U.S. will change. I don't like saying this. I'm an American, but I can see what's happening. It's not going to be good in your lifetime.
Tell me more about your way of doing research for investors these days about China. What should they know? Where to find the information you think that is reliable? And how would they compare the research they do here vis-a-vis about the United States or Europe? And the list goes on. Jim.
Oh, Conway, I wish it were easy. What I have found is it's very, very difficult to do research. If you're interested in an industry or a country, you need to read as much as you can about that country. You should visit that country if you can, because the more you know, this is not easy. I wish it were easy. Oh, I wish it were easy. One must read and read and read and then read some more. And then when you think you know what you're doing, be very careful, because things are changing all the time.
Yeah. What are some of the benchmarks, Jim, you're watching very closely, either when it comes to the current White House decision about the U.S. economy and its relations with the rest of the world, including, of course, China, and also about the China's approach, how it will be shaped in the near future vis-a-vis its relations with the rest of the world? What are some of the benchmarks you're watching these days very closely?
The most important thing for China is to open itself more and more to investors, to travelers, to everything. And I would encourage Chinese to travel, and I would encourage foreigners to travel to China.
On the last point, encourage foreigners to travel to China. You, back in the 1980s, traveled in China on the motorcycle and got very grounded information now of what China was. And as a result, figure out what China is with that backdrop. How important it is for people really to go in this country and find out more in depth rather than just what the media have told them, especially media from their own organization and their own countries.
In the 1980s, I went back to America and said, China, China. They said, no, 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 Japan, Japan, Japan. Everybody was keen on Japan in the 1980s. But I had been to China. I had traveled in China. I could see what was happening. The whole place was booming, changing very, very, very fast. But people did not understand that because they listened to propaganda. I could see what was happening because I was there. So I suggested to Americans that they go there, but that's the same thing now. In 2025, 2030, everybody should travel as much as they can, Chinese and other people, because then you will see. If you see things close to the ground, you will see reality.
Jim Rogers, always a great pleasure, sir, chairman of the Rogers Holding. Thank you so much, and good to see you again. Joining us in Shanghai, Dan Wang, China Director of Eurasia Group. Good to see you, Dan. And in Henderson, in the United States, William Li, the Chief Economist at the Milken Institute. Good to see you, Mr. Li, as well. Now, China is working on its 15th five-year plan. This is a national plan being drafted at a time of great turbulence in the world. Now, Dan, given your knowledge of the Chinese economy, 5.3% for the first half of this year, that is really hard to come by. But how likely this is going to be sustainable, and what does that say to the 15th five-year plan?
We cannot see the whole year growing by higher than 5%, because that would mean a much bigger fiscal stimulus, which the government is unwilling to do. At this point, it's more important to defend the baseline, especially to contain the financial risks. So I think the government in the rest of the year would help to, first of all, target the important vulnerable groups, low-income groups, migrant workers, college graduates. And on top of that, there will be necessary rate cuts and fiscal stimulus, but none of those will be excessive. So one thing we have noticed is the strong performance of consumer market in the first half of the year. But going into the second half, the risks are much higher, because the market sentiment has deteriorated significantly since the Liberation Day tariff. And many of the small business investment since June has stalled. And that means in the second half, despite of all those supporting policies from the central authorities, people will be in the wait and see mode. And also in the first half, most of the new orders have been done for the US market. So the second half, new orders for this market will collapse. And that means the Chinese companies will have to look very hard for alternative market, probably in Europe, in Greater Asia, or even in Africa. And for Chinese companies, they're going global with even stronger enthusiasm. But in the short term, moving resources around, it can be very costly.
But you also witnessed, Dan, over the past week, numbers in the United States, for example, employment, and also the possibility still of inflation, as well as the economic situation is not as impressive as earlier expected, even though the revenue, federal revenue coming from tariff is rising. So what do you make of that, especially when people are making a comparison, if they want, between China and the United States?
Well, that has parallel effect on China's export to start with, because although the traditional trade is heavily affected, that's through the factory, the trading companies, and then American buyers through that chain. But many of the Chinese companies are getting into e-commerce, directly selling from the factories to the American consumers. And that means a very different game. The profit margin is also different. Previously, something produced in China at $1 would sell at about $7 in Target. But now, with the factory directly cutting all the middlemen and selling to the consumers, they can sell a similar product at, say, $3, $4. Even with the 54% of the tariff under the de minimis rule for low-value added goods, this still means that it's very profitable for Chinese exports. And what we're going to see is a faster transition in the business mode for Chinese sellers. But simultaneously, the U.S. market is facing a lot more weakness than people have thought, and that means they will rely on Chinese goods more rather than less.
Very interesting situation. So all of your arguments seem to, lead me to the discussion about exactly what is going on with the tariff war and what about China and the U.S. at this moment, especially China. Now, Mr. Li, we see the White House has started another new round of throwing tariffs to different trading partners. For example, Switzerland, India, South Africa, Brazil, none of these countries are not very satisfied with the latest quote-unquote announcement by the White House. Now, where are we going from now until, August the 7th? Is this more tactical or is this more strategic in terms of U.S. Not necessarily predictable of its tariff regime anymore?
Well, I think President Trump announced a fairly clear set of requests and demand for coming to the table to bargain. The initial round of reciprocal tariffs were set very high in proportion to the bilateral imbalances that the U.S. faces with various countries. And President Trump, I think, made it very clear it's not just about the tariffs, it's about the non-tariff barriers as well. Because in the years of WTO, there have been many, many rounds of tariff reduction. So many countries have already reduced their explicit tariffs, but their markets were not open in the sense that they put in place a lot of non-tariff barriers. So the high tariffs that were presented during the first round represented a summary of both tariffs and non-tariff barriers that are perceived as restrictions on trade into those other countries by U.S. firms.
What you're saying is really the argument, right, that's being repeated over and over again over the past few months by the White House. But the question is, what about the results? We have seen some interesting development. Earlier, now U.S. can use the leverage of both the market size and also of the security dependence of its quote-unquote allies earlier to get some good deals. But the question is, well, the U.S. is getting what they consider as good deals. What about the others that are moving around the world? Whether they are also trying to figure out what is the best deal for them, not just with the U.S., but also with everybody else. And what does that mean for the overall global trade order? It is still a premature question to ask, but then what about your observation?
I think the world now is in a complacency mode. So for countries like Japan and many countries in Europe and EU as a whole, they want to strike a deal with the US as soon as possible. Political pushback domestically is very high, and they also face the political leadership change if they don't strike a deal fast enough. But overall, that means the cost of production globally has been driven up permanently. And the US economy is enduring this high inflation for a very long time. And I don't think that the US economy can sustain like this. The President Trump's intention to change all those top officials in Federal Reserve, in the Stats Bureau, are bad signs for global investors. And the weakness in dollar might also persist. So for the rest of the world, it is the precise moment to reconsider this new trade order. It is about setting up a new regional trade agreement and also to defend the WTO rules. For China, it is at the very forefront of this endeavor. But one difficult thing for China to do is that its products are much cheaper than its competitors. Even at this price, that the Chinese yuan doesn't have to devalue to gain an advantage, already very, very competitive. So how to collaborate with the European market, with ASEAN market, is another critical question.
Especially the changes that we have seen decades ago, you would see the U.S. economy 25% of the global GDP, the rest of its allies also bringing in a big chunk of the global GDP. But now you see that change, quite impressive, in fact. What we do not know exactly what it would mean. 45% of GDP of the world is actually coming from what they call the emerging economies, developing countries. Of course, this trade war and tariff war is going to have an impact on that, but still, it's a very different picture. So how, William, Now, does Washington articulate this, especially during its talks with China? We see the third round, both of the negotiators, including the Treasury Secretary and also the trade negotiator, chief trade negotiator, has been talking about improvement and also mutual understanding between the two sides. The Chinese are also quite clear in terms of that the third round still works based on the earlier two rounds. So how much will these be able to create some kinds of certainty for both economies at all? And of course, people are also thinking about top leadership meeting, but that's only being discussed, not necessarily confirmed by either of the side. So tell us more about your thoughts on this for the next half of the year.
I think history has taught us that in negotiating with the Chinese, especially during President Trump's first round of negotiations for those trade deals, it takes a long time. And I think people are now sort of in that mode of thinking it will take time to get something really concrete and firm out of China. And right now we need to have the building of the framework. What is it that we can agree on? What is it that we can minimally start to do in terms of rare earth metals and purchases of American technology by Chinese high-tech firms? So I think the approach is to take baby steps and to reach these initial agreements and to have them start to work out before going on to more ambitious goals. So I think for China, the discussions are fairly contained, but the ambition is to make progress and not to fall back into disruptive rhetoric and have discussions shut down. For the rest of the world, I think the key is to rethink supply chains. And in terms of the United States, there are certain sectors that are considered very strategic, very important, and consumers are going to be willing to pay a high price for in order to ensure that kind of security. Pharmaceuticals, medical supplies, a host of different sectors in which the U.S. has lost its capacity to produce. So I think that's one thing that is going to be reshaped going forward in the next 6 months. What sectors will the U.S. pay higher prices for, and what sectors can we make deals in a bilateral way to diversify the supply chains? Now, in terms of really the environment itself, Don talked about the weakening dollar. Well, it's still higher than it's been in the last 5 years. So it's higher than the average of the last 5 years. And I think the drop in about 8-9% in the last month or two has really come off historic high level. The drop of the dollar or the appreciation of the other currencies has really taken some of the edge off of the tariffs. So in that sense, it's worked in its favor of promoting trade. But I think the key is whether the U.S. remains a place in which you want to invest. And will foreigners continue to put money into the United States? And I think the strength of the dollar will depend upon the attractiveness of the U.S. as a center for investment. And to bring up another jargon term I've mentioned before, which is the Lucas paradox. Right? Robert Lucas, the Nobel laureate, said, how is it that capital-rich countries like the United States are attracting capital away from capital-poor countries? Well, it's because that's the highest rates of return are here in the United States. So that paradox of capital flowing into countries that already are abundant in capital, I think says a lot about why the United States can be and should be a place where countries should consider investing their dollars. And that's exactly what President Trump has asked people to consider.
How attractive is China as a result of all of these, once again, moving factors?
China is very attractive in certain sectors if we're talking about a real economy, because the businesses and the capital, they follow the money, they follow profit. And for the shipping industry, logistics industry, the green products, especially still the solar and wind turbine technologies, China is the place to go. There's no alternative. And for other type of businesses like consumer market, it's extremely competitive now, even within China for the local producers. Anyone that wants to get into the market won't face a very, very easy time. We talk about involution and anti-involution, but behind that is really the cost-effective model within China. So I don't think that the global investors have lost interest in China. It's just that some of them have lost the competitiveness. That's one. And the second point I want to make is we're facing two different types of China. One is focusing around the future, and that is the transformative technology targeting the future. So the global investors are very much interested in Chinese companies because we're able to produce the best companies in the world. But when it comes to the real economy, that weakness is quite persistent because China still needs to find a stronger engine to replace housing. Since the peak of 2021, Chinese housing has contracted by about 1/3 in value added, and it's used to be about 20-30% of the GDP growth. So even with a loss in that growth, China is still able to grow by 5.3% in the first half of the year. That's very impressive. But it also means to continue this model, China has to speed up really to invest in the high tech because productivity is the ultimate savior for growth. We can't rely on the capital intensive model or the over leveraging model. And that also means the transition period will be very, very painful for certain groups within China and also for FDIs. In the trade talks between China and the US, the focusing point right now is on tariffs because China really wants to lower the tariffs, especially the one that's related with fentanyl. And it's promising that 20% tariff can be gone by the end of the year. But all the Chinese businesses and the government officials are quite aware that tariffs is not the key problem between US and China. If tariff is the key problem, then China doesn't really have a problem because it's all about President Trump. Tariffs are easy to impose and easy to roll back. And in the future, the competition is still in high technology. So the US chip export ban has been relaxed in recent months, but it doesn't mean it can sustain forever. And for Chinese high-tech companies, especially the AI industries like DeepSeek, like Alibaba, they need high-end chips. If it's not from the US, then China has to be able to make it ourselves. So the 15th five-year plan will focus more on investing in the future. On the resources allocation will still be very heavily leaning towards that sector. So that means probably domestic economy, the demand weakness will sustain in some sectors.
Dan Wang, William Li, thank you so much for joining us. Appreciate it. And that's all the time we have for today. If you'd like to know more, search World Insight. Check out our YouTube channel. Follow us on X and Facebook. I'm Tian Wei on behalf of the team. Thanks for being with us, and I'll see you tomorrow. Bye for now.